at stop rates of 23s at 9.2. The 2035 was at 11.7, and then the 2050s were at 12.6. In addition to that sale, they also sold to non-competitive, which typically makes up of government power standards and other agencies, of about another 94.5 billion. So if you total everything together, yesterday the government basically raised about 390.7 billion in debt issuance. Obviously, this is not surprising, and if you could recall, back in April, the government basically cut down the revenue expectation in the budget. So that projected before that they would get revenues of about 8.4 trillion, but they now cut that to about 5.08 trillion. And then obviously that would definitely increase the deficit. And I mean they also cut down the benchmark from about 57 per barrel to about $30 per barrel, and production as well was cut from 2.18 million barrels to about 1.7. So basically, there's a big revenue shortfall, and the government deficit has definitely increased. So far, they've prior to now, they have raised 817 billion. If you add yesterday's issuance, we've now raised year to date about 1.2 trillion in debt. But still going by the deficit, we still expect to still be issuing about 1.6 trillion more in debt across the treasury bills and the bonds. So I mean, where do we now see rates going from here? I mean, we believe in the short term, market will definitely react because there was a lot of supply yesterday. So if you look, I mean, they are in the calendar that proposed to issue about 60 billion in debt, and they sold about 390. So we expect that the yields would trade wider today at market open. But going into the future, I mean, in the medium and long term, because of the open maturities we have, I mean, we have about 6.9 trillion from now till the year end. We just believe that the yields will be range bound around current levels, maybe with just a bias of about another 50 basis points uptick. So if our asset managers and pensions, you should be buying close to the auction, because that's where you see supply. If you don't have cash, you're able to buy bond forwards, in order to take advantage of all of those optics. Because of the revenue, because of the liquidity cycle, you probably just see compression in yields when those liquidity hit the system.
Fantastic, good stuff, Wanola. So you've taken us through government tapping the domestic market. As you've mentioned, because they wanted to convert foreign debt to domestic. So they came to the market yesterday, sold some federal government bonds. You've gone through the rates. You also, your advice was, for, I guess, asset managers and pensions, but for individuals, I guess banks will be buying into these as well. So for individuals listening to the show that have been hoping to see rates rise as a result of the government coming to the domestic market, is that's something people should be optimistic about in your view?
Well, I mean, banks have other demons to fight, right? I mean, banks are battling with CRR, they're battling with LDR ratios. So I mean, they're trying to manage both sides. I wouldn't expect rates in banks to move wider than where it is. But I guess for individuals, right, I think that the investment pattern will change over time. So we've seen people who typically just look to T-bills are now looking at the 3-year bonds. Some are now looking at the 5-year bonds. They might not do it in big sizes, but the investment pattern is starting to change. I wouldn't expect anything to change from where banks offer, because banks still have a ton of liquidity to play with. So for individuals, they should basically just change their investment pattern. I was also going to mention
Yes.
today as well. The government would raise another 150 billion in sukuk bonds, and they're offering a 7-year bond, 7-year sukuk bond at about 11.2%.
Okay, you know what? And then you just reminded me now. Thanks for mentioning that. So Sukuk bond, they're also going to be going there as well, 11.2%. Um, what's what benchmark should we be using as far as I mean, we know inflation is at 12.2%. We're still waiting for I don't know why we haven't gotten April inflation yet anyway, but well, whenever the Bureau of Statistics gives that to us, we'll get it. I thought we were going to get that last week Friday. But um so can we because T-bills, I mean, you just mentioned T-bills, Wanola, the rates there are abysmal. So should we be benchmarking against federal government the federal government bonds?
Well, I just look at it as your investment horizon, right? So what do you want to invest in? I mean, what maturity profile are you matching, right?
Mm.
So you then use that as a gauge. I mean, where inflation is and where fixed income is, I mean, it's very, very far apart. But if you're someone looking to invest for 90 days, if you're someone looking to invest for 180 days or 1 year, then you really don't have any choice, right? I mean, there are very few assets you can buy. Even if you look at the corporates as well, a lot of them are taking advantage of this. A lot of blue chip companies are also selling CP. In fact, there's one opening up today, and that will probably use around 5% thereabouts. We saw another corporate bond issuance early on in the week as well, for 5 years. So a lot of corporates are basically taking advantage of this, and I guess a lot of capital will flow into that direction. But for now, yields will still remain yields is expected to remain lower than inflation because the main drivers are different. There's just a ton of liquidity out there, especially from the OMO maturities.
Okay. Okay, fantastic. Thank you for that. So even in the short term, if you're gonna expect rates to go up, people shouldn't be too optimistic with regards to how high they can go because of the environment. That's the takeaway from that, yes?
Exactly. So I expect them higher than where they are currently,
Right.
but not like massively higher. So maybe another 50 basis points move at the top, for because the liquidity is still there, it's just going to keep yields at low level. So take for instance the OMO market as well.
Yes.
Last week, CBN did not conduct an OMO sale. Like they did offer an option, but they did not sell anything. And we saw yields tank from about 12% to now around 6 and 7%, even in the OMO market. So it's just basically if there's no supply, the liquidity basically compresses yield, and that's what you basically get over time. Yeah. So the liquidity cycle is, I mean, the normal liquidity cycle is still there from tracking flows, and then you have the OMO maturities, coupon payments. Those liquidity cycles would definitely need an asset to basically buy.
Okay. Let's see now. So we have a message. I think it's okay. Is asking how much can he invest? I think in the minimum investment to invest in the sukuk. Individuals can also invest in the sukuk now, right? Wanola. I mean, I know mostly institutions and so on will be invested, but individuals can also invest in sukuk, can't they?
Yes, individuals can.
Okay.
Individuals can. With regards to minimum, I mean, so for the typical bond auction, the minimum is about 50.1 million, right? So, but you can always get this thing. You can always get this thing in the secondary market.
Secondary market,
Well,
yes.
you said 50 million.
Yeah, you said 50 million. That's just about 50 million. So I think it's best, as he said, it's best to go to the secondary market where you can go through. It's almost like
you can get them much lower.
Much lower, right?
You can get lower expenses there.
Hey, it's because again, he's targeting mostly what is it now? HNIs, institutions, and so on and so forth. Okay, great stuff. So I see again, what a lot of our listeners, they've also been lamenting about the rates. So you mentioned Wanola, you mentioned commercial papers a few minutes ago, and you said a lot of corporates are taking advantage. But did you say 5%? I think you said 5 or 7%, right?
Yeah, I mean, so you probably see for the commercial paper around around 5 and
Oh
6%.
boy, yeah. You see, I just have the inflation figure in my head, and I just keep shaking my head anytime I see rates like that. But it's all that's fine. I mean, it's the environment that we are in, and I guess we'll just have to take what we see. Okay, so shall we move to FX, foreign exchange, with how you see things working out? I guess in the I&E window and other areas for FX.
Yeah, sure. I mean, the FX market as well has been, I mean, volumes have been abysmal, right?
Yes.
We've moved from $100 million volumes to some days 8 million, some days. I mean, so it's clear that, I mean, there's no liquidity there at current rate levels. So we'll be basically range bound around 388 to 390, right? And a lot of investors aren't incentivized to sell dollars around there. It's clear that the CBN obviously is trying to intervene in different sectors, so they've been doing weekly sales, the wholesale SMEs, the retail SMEs, but more of the focus has been on the manufacturing and agricultural sector. But the major liquidity provider in that market, which is the offshore portfolio investors, have basically been non-existent. A lot of them are still looking to repatriate their capital. I mean, we estimate that the outstanding demand there is about 1.5 to about 2 billion dollars. So a lot of them aren't compelled to sell at current rates. I mean, from some of the figures we've spoken to, I've said that, I mean, they'll probably look at rates around 425, 430 for them to look at the economy again, and obviously yields have to be much higher than where they are before they put in any additional risk. But right now, for the foreign investors, it's really more about return of capital at the moment. So bulk of the volumes we see in the market basically multinationals who have subsidiaries in Nigeria trying to match flow. So any of the subsidiaries that need funds, they sell to them, and then they use those funds for their obligations. And few of your portfolio investors as well would still invest. A lot of them also, I mean, from global custodians, they use some of the inflows for their own obligations. So what bulk of the volumes you see are matching volumes, not necessarily real supply into the system. We probably expect this to remain current if because oil price obviously are where they are. I mean, at around 35. So because if that definitely increases, then we'll definitely see more supply in the window.
Are we worried that once the foreign portfolio investors are able to repatriate their funds and exit, are we worried that they won't come back? What's your feel with with your clients you've been talking to?
Well, I would not say they won't come back because we've been in this cycle. I mean, a couple of times. This happened in 2016, and it looked like they weren't coming back, and then they did come back when the INA window opened. So to me, it's really, I mean, it's really around value, right? At the moment, they don't see the currency, they don't see the currency as appropriately priced around 390. So then the yields that have compressed is also not encouraging. So, but I guess if we see another round of deval, right, and yields basically inch up, then we start to see supply from the foreigners. A lot of them might say, "Oh, I will not come back. I will not come back." But we've seen this over time that they will. I mean, they will always come back. Another thing not to mention is that, I mean, if you see the futures prices, that has been repriced again, much higher than where they are.
Mm.
I mean, it's clear that CBN can no longer, I mean, afford to subsidize the futures market. I mean, so if you see the 1 year there is already over 400.
Mm.
But where we see value, I mean, from our side is I mean, for corporates and for investors looking to repatriate, we tell them to have 1 month to 6 months because there's still a bit of value there because you're still hedged, you're able to get your dollars out.
Well, I mean, if we've only got a couple minutes to go, but very quickly, I mean, if they're looking for another repricing of FX, I mean, we already had that. I believe it was in March or so, from 306 to 360, and I guess the CBN's language is that they're not looking to do it again. Is it that their hand have to be forced?
Well, I don't know. So I think it yeah. I mean, it really depends on. So the scenario now should have forced their hand, right? What we have now should have forced their hand, but they're really more concerned about the effects. So I can understand CBN's perspective with regards intervening to the manufacturing sector, and so that people, I mean, we can still produce, can still get the economy going. I mean, there's a lot of focus on health as well. Yeah, but at the end of the day, right? If your reserves continue to dwindle, you'll be forced to move the currency again.
Mm.
But right now, CBS has a bit of ammunition. Reserve is still slightly buoyant at around 35 billion. And that, I mean, part of the IMF money that came in is help stabilizing that. So they still have some time, to defend or support the currency around current levels. But
Nope.
if this lingers, and and when I say lingers, if oil price remains where they are,
Mm.
then it might force their hand. Yeah,
Gotcha.
for now, I think for between 1 and 6 months, they have enough ammunition to keep rates where they are. They'll keep basically intervening in sectors that they feel will help the economy.
Gotcha. All right, we've pretty much almost run out of time. Wonola, I can be the head of financial institutions sales, global markets at Stanbic IBTC. Appreciate you. So we'll end with some messages. Yes.
Yes,
Okay.
just one. MI from Akoka says, Reuters, when we mentioned 15 million, he forgot to add only. Also 5%. Isn't that a negative real return on investment?
Right, versus inflation. Yeah, that's a good point. Darlington, I see your message as well. Thank you so much. All right, Wonola, thank you so much. We'll catch you another time. Thanks so much for your insights. We appreciate you coming on.
You're listening to Smooth 98.1.
No problem.
Love music, love life. Thank you.
Business trends beyond the headlines. World business news from
Press and hold that button at the end. No, that button at the end.
This?
No. Yes. Thank you.
Thanks, man. I know we're pushing the time there. Oh boy, I have something I have to set up. I think I might still hang around downstairs. I have to send something real quick.
Alright.
Thanks, man.
You're welcome, bro.
Do you know that COVID-19